Okay, what I'd like to do is finish up the material in the chapter. We're talking about money and financial institutions and so forth, and probably one of the most important financial institutions is the Federal Reserve System in the United States. The Federal Reserve was created in 1913 in response to some earlier financial problems in the economy, and where they thought like a central bank type of system would be helpful. However, the Federal Reserve is not strictly a central bank. It actually consists of 12 Federal Reserve banks. Now, these are not technically part of the government, although it is in a quasi sort of way, and we'll kind of talk about that. And these are the names of the bank. I will not hold anyone responsible for giving me a list of the Federal Reserve banks. Probably the most important one is New York. New York is actually, of all these Federal Reserve banks, the New York Federal Reserve Bank is the only one that only covers one state. The others cover other broader sections geographically of the country. There's a nice little map in the textbook that'll show you which bank covers which areas. And they work together. They're kind of a network. Their mission is to assure the U.S. economy has growth while avoiding excessive inflation. And because they're dealing with the money supply for the most part. The board consists of seven members appointed by the president and confirmed by the Senate, which would make some people think, oh, well, the Federal Reserve is a branch of the executive branch, it's the White House and so forth. Actually not. It's fairly independent. It is not supported by U.S. tax dollars. The bank actually is the Federal Reserve system is self-supporting. And once appointed, the members of the Board of Governors and the chairman of the Federal Reserve can be quite independent, and it is varied, over history. Some Federal Reserve chairs and board members have been very independent. Others have actually, responded more to the will of the president. They are not strangely responsible. They are often called to testify in front of the Senate, but they are not actually responsible to Congress or to the president. But they are appointed and told to act in good faith. So in some ways it's good because if you look at fiscal policy, which covers taxation and spending, there's always a lot of fighting. Even if you're just a casual observer of politics, there's always fighting over what the budget is going to be and how much the taxes are going to be, and very political. And the Federal Reserve, you never hear about a lot of fighting. I'm sure there's some disagreements within the organization, but no one there is running for office. They are appointed and confirmed, as opposed there's no elections going on. One of the major responsibilities of the Federal Reserve System is to control the money supply, and it has a number of tools to do that. First, it controls what's called the reserve requirements for banks. Banks, if you understand how commercial banks work, essentially we as individuals and firms as well place money on deposit at banks, and then the banks then loan that money out and are paid back with interest, debt financing. What they'd probably love to do is to lend out all the money, but of course the trouble is, if you or I come to the bank and we want some of our money back, and they've lent it all out, that's a problem. And, so banks are required to keep a certain amount in reserve. That's the reserve requirement. It's, I believe, about 10%, but the Federal Reserve could, change that. I do remember one of my professors in graduate school was a big proponent of reducing the reserve requirements to 5%, which I believe some economic activities subsequent to my being in graduate school. Well, let me just say I'm glad that he didn't get his wish, because we would have had a lot more problems. But you can control the money supply this way, in that if banks have to keep more in reserve, let's say the Federal Reserve said, we're changing it to 15%. Well, they'd have to pull the back on the money that they lend out, and that would cut down on the money supply, the money circulating in the economy. Or they could loosen it and go to 5%, like my old professor said. Another major tool is what's called open market operations, and that is essentially buying and sell government bonds. How does the government finance its operations, particularly with deficit spending? They sell government bonds, and government bonds are very safe investments. They're low interest, but and there's low reward. They're low interest, but they're safe, and they're backed. They're completely safe because they're backed by what's called the full faith and credit of the U.S. government, essentially the ability of the government to print money. And while the government will sell bonds, the Federal Reserve can also buy them back, and that essentially pulls money out of circulation. So they can tighten up the money supply, or they can loosen the money supply. Generally, you would loosen the money supply during difficult economic times, a recession, that sort of thing. Giving people more money, allowing more money to circulate, and that will help people, help us get out of the slump in the economic cycle. But the Federal Reserve often will then, when things are doing better, tighten the money supply so things don't, the economy doesn't overheat. So there is that control. And their third tool is to control what's called the discount rate. Essentially, this is the rate banks pay to borrow money from the Federal Reserve. It's the bank's bank. So if a commercial bank wants to make out some loans and they don't have enough cash on hand, they can borrow money from the Federal Reserve, and they of course have to pay interest. Well, let's say, for instance, the Federal Reserve was charging 2%. Well, that means the commercial bank has to charge more than 2%. Now, how much more? That would depend upon the specific situation, and this way, the Federal Reserve System controls what the interest rates are. A higher interest rate is going to dampen economic activity. A lower interest rate will encourage economic activity, more investment. If you, let's say a company wants to build a plant, they need to borrow money, or somebody wants to buy a house, they need to borrow money. So lower interest rates will spur on economic activity. During the financial crisis about 10 years ago, where I'm recording here now in 2020, 2007, 2009, they brought the interest rates pretty low, and it took a long time for them to bring it back up. And a lot of people on Wall Street and other people in the financial industry hate it when they raise the interest rates, because that can retard. But what they're trying to do is prevent the economy from getting grow too fast. And of course, this is a judgment that these economists will make. And there's lots of debating and arguing over what the interest rates, what the discount rate should be. But that, so essentially those are three tools which the Federal Reserve System uses to control the money supply. And this is referred to collectively as monetary policy. The Federal Reserve also does a few other things. One is to operate the check clearing system, which this may become less important as time goes on, as fewer people write checks. If you think about it, all the people in the United States who write checks, the check has to get to, from there, get to who they're paying, and you receive a check, you put it in your bank, and that check has to get back to the bank that you wrote the check on, your personal bank, so they can deduct the funds and transfer them to the receiving bank. And the Federal Reserve has operated that check clearing system. And actually, the physical check would come back. I remember years ago, I'd write a check, person would deposit it, and eventually, a month later, I would receive a packet of canceled checks. Now with electronic technology, they just make a copy of it, and now it's available online. And I could see perhaps in the future the check clearing system disappearing. Certainly, if we stop writing checks and we go completely to other methods of credit cards and debit cards and all sorts of other electronic currencies, that might go away. We'll see. The Federal Reserve also has, we talked about open market operations, they have the Federal Open Market Committee to make those decisions. Again, that's the buying and selling of government bonds. And they also get into other aspects, but I won't get into that now. The FOMC has 7 board members. These were the Board of Governors appointed by the President and confirmed by the Senate. Plus, it includes the president of the New York Federal Reserve, the New York Reserve Bank, as well as 4 other Reserve Bank presidents, and they rotate their membership. I'm not sure exactly how often they rotate, but and these are the people who control the buying and selling of government bonds. How much will be sold and how much will be bought back. So that's a very important committee for all of us. So the Federal Reserve, again, very important. You'll always hear occasionally you'll often hear if you watch something like CNBC or other financial network, Bloomberg and so forth, they have meetings, and the meetings are known when they're going to meet, and of course there are always people in the business community and particularly the financial committee are waiting for what will the decisions be. Will they raise interest rates? Will they buy back bonds? That sort of thing. Mostly, I think they pay attention to the interest rates because that will affect investment. Most of us already do business with commercial banks. They are sort of a very important sector in our financial economy. They are profit-seeking businesses. They may even be publicly traded companies. And they have a wide range of offerings. First was what's called demand deposit accounts. And the idea is that you can put your money there, but you can demand it back at any time. And things like checking accounts, the more recent addition is debit cards, where you get it instantaneously. Often interest rates, if they exist on checking accounts, tend to be very low. I remember years ago, my first checking account, there was no interest rate paid because the idea is you can just empty the account at any time. And banks want a stable supply of money. They don't want to have the unpredictability. And that's why they will have what are called time deposit accounts, or what we would call savings accounts. Savings accounts usually have more restrictions. You would actually have to come to the bank to withdraw the money. And I'll refer back to that in a moment. And of course, savings accounts used to have, again, these time requirements. You couldn't take out so much in a day. It was meant not to be quite as liquid as a checking account. Going in the opposite direction, you can get what are called certificates of deposit, or CDs. And these are essentially you're giving the bank the money with the agreement that you won't take it out until a certain time, a predetermined time, and you can get 30-day CDs, 3-month CDs, 6-month CDs, 9, 12 months, multi-year CDs, and you'll get a higher interest rate. But of course, if you need the money, you can get at it, but then you pay a penalty. So the idea is you don't want to put money in a CD unless you need to access it. I remember my son just as he was getting to college, he started to manage his own financial affairs, and he wanted to deposit some money, and somebody sold him on a CD and saying that you can get a better interest rate, and that's all he heard. What he didn't hear was that he had to keep it on deposit for a certain time, and because this was Wells Fargo, which had subsequently had a crisis, a scandal, where they were overselling certain things and they were trying to open up too many accounts. In fact, some of them were fraudulent accounts. I actually went there the next day and I kind of yelled at them. I said, you know, this is a young kid who he needs to be liquid. He needs his money. He was going to have a lot of unknown expenses coming up. I said, you don't put this kind of kid into a CD. And they, to their credit, they backed off and said, we're sorry, you know, somebody was just a little over enthusiastic, and they actually rescinded the CD. I actually, I'm on the board of a nonprofit organization, and I don't really handle the finances, but I along with the rest of the board, I approve the methods and the decisions being made. And essentially, what they do, they have some reserve funds. You know, they have their checking account, but they have some more. And what they do is they actually have, I believe, 6-month CDs, but they don't all come due in the same 6 months. They'll be staggered, and that way, if they never ever need money, there'll always be a CD close to maturity, close to being where they can take money out. And the CDs are often rolled over. If you ignore a CD, most banks will just roll it over into another 6-month CD or whatever the time is associated with it. And CDs are, you know, good if you have the cash. You don't want to risk it. Commercial deposit accounts at banks are insured by the Federal Deposit Insurance Company. You may hear the term FDIC insured. So if you're depositing money at a bank, it is insured by the federal government, which is nice to know, and that gives a certain stability to banking. And we'll come back to that a little bit. Actually, we'll come back to it right away. Investment accounts, they will, again, there's a difference between savings and investing. Things I've just spoken about are all savings accounts or variations thereof, this putting money on deposit. Commercial banks can also offer investment accounts where you can invest in stocks and bonds and mutual funds and a whole bunch of other things. That money is not FDIC insured. And during the Great Depression, one of the things that contributed to it is that banks were taking money that people put on deposit, and they were taking it and investing it in the stock market. And when the stock market crashed in 1929, a lot of people lost their money. So what was passed was something called the Glass-Steagall Act, which said you could be a commercial bank, say where you do, we'll talk about other certain mortgages and things like that. Or you can be a Wall Street type firm where you're investing and taking risks. And that held up for many decades. Actually, under the Clinton administration, it was revoked, and they revoked Glass-Steagall, which I don't particularly, my personal opinion, was not a great thing to do, but we have not had a fallout specifically because of that. I was really kind of upset one day. I discovered that my regular checking account wasn't a demand deposit account. It was actually an investment account. They called it a command account, which was a marketing name, not a. One type of investment account they will often have here called IRAs, individual retirement accounts, and we'll talk about some retirement options. And that's something anyone can do. You can put money away. It actually, depending upon what kind of IRA it is, you may actually be able to reduce your reported income to the government at tax time. So let's say you're making $35,000 and you put $5,000 in an IRA, that will be deducted from your $35,000. So the government will only tax you on the $30,000. So, that's an interesting. Now, they also have something called Roth IRAs, which you don't do that, but it has benefit later on when you actually retire. You don't have to pay money. The idea with a regular IRA is that you will pay tax on it, but only after you withdraw it during your retirement. The Roth IRA, you pay the interest, you pay the taxes now, but then later when you retire, you don't. Another service that is offered by banks are ATM, automatic teller machines. I know most of you probably almost all of you. I don't remember a world without ATMs, but an ATM is obviously an automated machine. You can make deposits and you can take money out of your account, out of your checking account or even savings account. You can't do it with a certificate deposit. But before ATMs, if you want to take money in or out of your bank, if you wanted cash, you had to go during banking hours, which was like from 9 o'clock to 3 o'clock. They were still open at 5, but they weren't. You couldn't go in. They were handling their books. Banks are open longer now because obviously they have computers now, which can handle a lot of the work they were doing in the final 2 hours of the day. They can do it much more efficiently. And of course, they also offer loans, mortgages. You can borrow money to buy a house, and the house is the collateral. Right, the same with car loans, business loans. Business loans are a little bit trickier, but they are offered by commercial banks, and of course, they charge interest to pay back all those other types of offerings. The time deposit, demand deposit accounts, time deposit accounts, certificates of deposit, and so forth. And you're all familiar with, I'm sure you all have experience with commercial banks. There are also savings and loans, but they have kind of mainly morphed into banks for various reasons I won't go into. Another thing, financial institution you may be interested in are credit unions. Credit unions are great, and one of the key thing is they're not-for-profit organizations. They are not trying to make a profit unlike commercial banks. So, which means they can give you better interest rates. They give you better rates on loans, that sort of thing. Usually they are associated with another organization. For instance, I had a credit union account it was called the Merck Employee Federal Credit Union. Actually, my wife, who also worked for Merck, still has, even though she hasn't worked there in over 20 years, still has an account there. If I want, I closed my account, but if I want to go back and open up an account, I don't know that I would be allowed to since I'm no longer an employee. And it offers very similar things to services as banks. If you can join a credit union, I would encourage you to do so, because you have slightly better interest rates, whether you're a lender or a borrower, or a depositor or a borrower. Some downside: they do have fewer ATMs. That's one of the reasons I finally decided I didn't want to be there anymore with that credit union, because the closest credit branch to my house, I think, was Rahway, New Jersey. I think there's one in White House, but it was kind of a pain out there. Also, they have fewer branches. This particular federal credit union was only at their major facilities, and so that was kind of inconvenient. When I worked on the site, it was very convenient. When I no longer worked for the company, it was very inconvenient. So after a few years, I finally closed my accounts about 2 years ago. And actually, the reason that triggered that is that a lot of the credit unions will network together. And that's to compensate for their fewer branches. But the credit union near my house was another organization that networked with the Merck Credit Union. They just decided to no longer do it. I don't know why. So they became even less convenient. So there you go. Um, Pension funds are another one, and this again goes towards retirement. Um, any organization, a company or a governmental or nonprofit organization or a union that you're associated, that you're paid through or paid from, you can put aside money for your retirement. And this is often a benefit or perk to attract good people. Unions often set up pension funds, and the idea is they will put money aside for you. As the longer you work, the longer the more you'll get when you retire. There, of course, are all sorts of stories about pension funds. Pension funds being raided, companies who get into trouble. Where's one source of cash they can dip into the pension fund, and some people have gotten screwed by that. Even unions have pension funds that are run by unions. The pension fund often serves as a backup for, if there's a prolonged strike, they will pay their members from the pension fund. So, and of course, there's been a lot of malfeasance with, union pension funds and pension funds in general. Pensions are generally good. I will receive a small pension from Merck. I didn't work there. I think I worked there about 8 or 9 years. So I will only get a small pension from them. I don't know exactly how much it's going to be, but there you go. If I had worked, for 20 or 30 years, that would be far more substantial. Often loans can be taken against pensions. So if you're having a cash flow problem, you can tap into it. Of course, you need to repay it, or else you will forego receiving pension benefits. Another problem with pensions is that it's hard to project what the liabilities will be because you don't know how long the pensioners, the people receiving pension funds, are going to live. And it's become more of a problem because people are living longer. Life expectancy is increasing. I think I mentioned my mother-in-law is 100, and more people are living that long. It used to be the average lifespan. For instance, when they established Social Security, it was like 68 or somewhere around there. That was the average. Some people obviously live longer. So pensions can be somewhat problematic, and as a result, I forgot to mention, they tend to be invested in low risk investments because obviously they need to grow to meet the demands of the pensioners. But many organizations are actually phasing out pensions in favor of 401ks or other retirements. When I told you I worked for Merck, and what they did is they spun off my company, my division, and merged it with another company's division and created what's called a spin-off company, and I'll probably talk about that at some point. And my pension didn't follow, and they didn't. This new company didn't have a pension plan either. Now I'm still entitled to the pension from Merck, but and what they did instead is they beefed up the 401k program. Now 401k is a retirement program, but it works differently than a pension. What they did is, at least what mine was, is you could put away part of your own percentage of your paycheck. It was yours. It was still yours. You could put it away, and Merck would match for if you put up to 5% of your salary into the 401k, they would match that 5%. So it's sort of like getting a 5% raise, even though you can't pay, you cannot access it immediately. You'll be able to access it down the line, and that was great. You could also borrow against it, but it's now the employee's responsibility to choose investments, and they kind of help with that. There are other variations, like for instance, I have part of my salary, my pay put away from working at the college, and that's called a 403b, and that's more for like state schools and that sort of thing. And there are other variations, but and these yeah, and I actually what I should with Merck, I actually put away 7%. Even though the extra 2% was not matched. Uh, it also reduces your tax liability. So let's say again 30,000. If you paid 35,000, you put 5,000 in your 401k, you're only going to get taxed on the 30%. So there, it has some benefits. Has actually a lot of benefits that way. Actually, the 401k I think was a very ingenious idea, and I strongly encourage you, even though you're not thinking about retirement. I know that, but as soon as you are able to access a 401k and you can afford it, I would start putting money away. The difference between in retirement between people who do well and people who are just getting by is the most important factor is how early they began putting money away. That was more important than which investments they chose. So obviously, as you're younger, you would choose more aggressive investments because you'd have time to recover. Somebody who's, let's say, my age should probably invest in things, more like safe stocks, bonds, safe mutual funds, things like that. But when you're young, you can be much more aggressive. And but the fact that you start earlier, even if you pick something that was safer and had a lower return, it's more important that you start earlier. That way, it builds, and you get compound interest. You're maybe in stocks, or you have dividends reinvested, that sort of thing. So you'll thank me in 50 years if you follow that advice. Another institution are brokerage firms, and they handle investments in stocks, bonds, and mutual funds, and probably other investment options. These are more sophisticated, usually higher end. Think of the Wall Street firms. They're investing in stocks and handling other people's money to do that. Again, investments are not FDIC insured. So if you invest in Coca-Cola and Coca-Cola goes bust, nobody's going to insure that. So and again, now commercial banks can also engage in brokerage activities. So that's why some accounts in your commercial banks are not FDIC insured, where others are. It depends upon what you're allowed to do with the money. Okay, there are various securities markets, and these are a way of providing, able to acquire long-term financing. The idea of selling your stock in the market. There are kind of two general markets for that, even though it's in the same place. There's a primary or IPO market, a company that is making its stock available for the very first time. Usually, they could, of course, make it available. You could do multiple public offerings, but generally, most companies tend to stick to one, unless they really need cash, because then they're diluting the ownership. So usually they do that very difficult. And so that's how they get money. Now, the secondary market is, why would people buy shares in your company if they don't have a way to resell it? So, for instance, if a stock goes up, usually the company doesn't get any more money. They've already sold their shares. So it's just the owners of the stock that will benefit if they sell their shares to other people. And so when you hear about stocks going up and down, that's the secondary market. It's the companies are not getting the money. It is the owners. And hopefully all of you have signed up for StockTrack, and you're experimenting with that. And you're essentially, even though you're not technically investing in the market, you are essentially doing an exercise in the secondary market for stocks. It's essentially reselling. Rarely will anyone be able to buy directly from the company. There are ways to do it, but usually it's not It's not something that most people will deal with. Usually, you're talking about specialized people with specialized knowledge doing that. And there are various exchanges. You're familiar with some of them: the New York Stock Exchange, the Nasdaq. There's all bunch of exchanges around the country, the FTSE and the Hang Seng. That's in Hong Kong. And so usually a stock is traded on one particular exchange, but they're all connected, so you can do that as well. And in the United States, it's governed by the Securities and Exchange Commission. They lay out a lot of rules about what you're allowed to do and what you can't do. Some of these rules make a lot of sense. A few of them are annoying, but I won't go into that. And some other options are, instead of buying an individual stock, you can buy into a mutual fund in which you're essentially purchasing a basket of stocks, and the mutual fund manager is deciding which stock to put into the basket, into the fund. There's a number of different types of mutual funds, and I'm sure people are coming up with all sorts. There are index funds. Index funds are actually mostly unmanaged in that they've picked an index, and there are all sorts of indexes. These are various collections. The Dow 30 is probably one of the. You see the Dow going up, or Dow going down. That index is essentially based on 30 stocks. Usually the high capitalized companies, high value companies. And they're all names that you would probably know, and they have changed the Dow components. For instance, most recently dropped, I think, is General Electric, which was a major component for many decades, and because it dropped in value significantly, they switched in. I don't remember which company they put in. Or you can do other indexes. There is the S&P 500. Standard & Poor puts their index together of 500 stocks. The Russell 2000, and other indexes. And the idea is that you buy into all those stocks that are in the index, and you don't go in, and the fund manager doesn't go in and out. Whereas other funds, they will make investment decisions for that, and they will study it, and they, of course, are experts. That doesn't mean they can't be wrong. You may have sector-based funds. For instance, if you think a particular industry is going to do really well, you may find funds that invest primarily in that sector. There are some, pharmaceutical funds where you don't necessarily feel comfortable picking which company will do well, but you feel the sector will do well. Or maybe it's energy-based funds, or telecommunications-based funds. You just know that area is going to do well, but you don't want to pick the specific winners and losers there. There are also many companies, many funds that will put their collection together, and one of the factors will be the capitalization size. Are they large companies with large ownership, or mid or small caps, small capitalization? And it has to do with the overall value of all the shares added together times the price. And that's kind of what they're looking for. There are bond funds, and there are all sorts of municipal, federal government bonds, municipal bonds, other types of bonds. Some might include commercial paper, that sort of thing. Hedge funds are more of an elite type of thing, where it's very heavily managed. You have to have a lot of money to get in on a hedge fund. So I will probably never, probably be investing in a hedge fund. And there are slightly different rules for hedge funds. So essentially, I believe the managers will do how well they do is based on how well the hedge fund does. I remember one hedge fund manager had a really bad year, and he actually waived any of the fees. Usually there are fees that you have to pay, but the returns are usually higher. So that, that's for millionaires and billionaires. Bonds, we've talked about corporate bonds, corporate paper. There are also government bonds, and these are these are bought and sold all the time, based on what the interest rates are doing. And maybe you bought a bond that had a higher interest rate, and now interest rates have gone down, so that makes your bond much more valuable. And there are people who will, that's what they do. I have a distant relative who was a bond trader. I've never talked to him about bond trading, but government bonds, which we've kind of talked about previously. If you are getting into stocks, there's something you might be aware of, are stock splits. Stock splits have become fewer and fewer, but actually, I believe Apple did a stock split recently, so they're not completely gone. And the idea is that each shareholder will receive additional shares on a particular date. They've decided on a particular date, everyone will get extra. It might be. Often it's for every share you have, you'll now have 2 shares. So it essentially doubles the number of shares. That does not double the amount of money, the value of them. Actually, what it does is, so if you had 100 shares at $10, that would be $1,000. So if you then made it 200 shares at $5, it's still the same value, but it reduces the value of it reduces the share price, which makes it more affordable for someone. The idea is that it would eventually drive the stock price up, the value up, because more people will want it. For instance, a lot of people stay away from Amazon stock because it's very highly priced. Shares, a lot of people prefer to buy shares in blocks of 100 shares. It's very difficult to buy 100 shares unless you have a lot of money. And I haven't checked today what the Amazon price was, but it's up there. Actually, when I worked for Merck, we had a series of stock splits within a few years, and it was a very hot stock. Then, in fact, we even got a 3-to-1 split one time, so that was kind of cool. So it reduces the price per share, and it also reduces the dividend per share. But that doesn't mean you're going to get less money; just lower dividend per share, but you have more shares. And as I kind of said, shares are more affordable, and it makes shares more affordable in 100-share blocks. If you get into really small, buying really a few, like a handful of shares, it's not as economical. So the tradition is you buy in 100-share blocks, and usually when I've bought or sold, it's in the 100-share blocks. Occasionally, I've done odd amounts or smaller amounts, but that's very rare. It also makes the math, very easy in 100-share blocks. Okay. You can do what's called buying on margin. This is, of course, a much riskier approach. Essentially, what you're doing is you're borrowing money from the brokerage firm to purchase stock, with the anticipation that the stock price will go up, and therefore you can sell it, and then you'll have more money, and then you pay the brokerage back. Of course, the brokerage is going to charge interest, so you have to believe that the stock will go up at a higher percentage than the interest that you have to pay. So it is a riskier endeavor. And the trouble is, what happens if the stock price goes down? Then the brokerage may issue what's called a margin call, and you have to pay the difference between what you borrowed and what the value of the stock is. I do not recommend buying stock on margin, and I certainly have never done it, and I never will. And of course, if you fail to pay the margin call, the brokerage can sell your shares because just to cover their losses, and they have that authority since you've bought the stock on margin. Okay, obviously you can't ask me any questions here, but certainly when we get back together in face-to-face, in our remote live class, If you have any questions from this section, this lecture, certainly we can talk about them. So take care.